There was a time when Indian IT stocks defined Dalal Street. Names like TCS, Infosys, and Wipro did not just dominate the sector, they shaped the direction of the entire market. Today, that dominance is fading. According to Bloomberg, the combined weight of India's 5 largest IT companies in the Nifty 50 has fallen below 7.6% for the first time in more than 2 decades. That's the lowest level since at least 2002. So what has changed? And is this just another down cycle or a structural shift in how investors view India's IT industry? Let's understand in Markets this week. A company's weight in the Nifty 50 determines how much influence it has on the index. The higher the weight, the greater its impact on overall market performance. In the early 2000s, India's 5 largest IT companies accounted for more than 20% of the Nifty 50. Today, that figure has dropped below 7.6%. That isn't just a decline in share prices, it reflects a significant shift in market leadership. So why are investors pulling back? Well, the biggest reason is artificial intelligence. For decades, Indian IT companies built their business on global outsourcing. Large corporations outsourced software development, maintenance, and technology services to India because it was efficient and cost-effective. Generative AI is beginning to change that equation. Tasks that once required large engineering teams can now be automated. That has raised questions about the long-term growth of traditional IT services. Investors are now reassessing how much they are actually willing to pay for that business model. And the market performance reflects those concerns. The Nifty IT index has fallen 29% this year, and over the same period, the broader Nifty 50 is down only 9%. But earnings expectations are only part of that story. There's another force accelerating the decline: passive investing. As IT stocks fall, their weight in the Nifty 50 automatically declines. And when their weight declines, index funds and ETFs that track the Nifty are forced to allocate less money to the sector. Nifty 50 linked funds now manage around 5 trillion rupees. At today's weighting, they hold roughly $350 billion worth of IT stocks. Had the sector retained its earlier dominance, that allocation would have been closer to 1 trillion rupees. So in other words, falling prices reduce index weights, lower index weights reduce passive buying, and weaker passive flows can add further pressure on prices. The shift is already visible. Infosys, once the world's largest stock in the Nifty 50 by weight, has slipped to 8th. TCS now ranks 13th. Technology has also fallen to become only the 5th largest sector in the index behind financials, consumer discretionary, energy, and industrials. So is this the end of India's IT story? Not necessarily. Indian IT remains one of the country's largest export industries. The sector still generates billions of dollars in revenues, employs millions of people, and remains central to India's services economy. Companies are investing heavily in artificial intelligence, cloud computing, and digital transformation. But for now, investors are waiting for evidence that those investments can offset the disruption AI is creating. Until that becomes visible in earnings, the sector may continue to lose influence within the market, even if its long-term importance to the economy remains intact. That's it for today's episode. For more such market explainers, follow Business Standard.